So I bet you can relate to thinking about your future no matter what age you are. And if you're doing that, you're probably thinking like, hey, I want to retire someday. What does that actually mean? Well, to know that, we actually just need to know what a retirement plan is in general. So let's start there. Now, retirement plans are savings plans that people use basically for their future. And retirement plan contributions are usually contributed through stocks, bonds, mutual funds, or any number of other investment vehicles. And as far as taking the money out, most retirement plans want you to wait until you're of retirement age, but you can start early withdrawal as soon as 59 and a half, and you have to start taking money by age 72. So if you don't take money before or you take money after, there's a chance you might get a penalty. So it's super important to understand the tax implications of each plan, what you can do with the money once it's invested and it's matured in there, and how you are supposed to withdraw it for use to avoid any unnecessary penalties or fines, fees, so on and so forth. Now, like I said before, there are several types of retirement plans, but for purposes of this video, we're gonna start with the basics, the foundation, and we're gonna look at three of them. We're gonna look at 401k, a Roth, and a Roth IRA. So take action now with retirement, and your future self is going to thank you later. So let's start with the 401k. So a 401k is an employer-sponsored plan that allows employees to make pre-tax contributions to a retirement account, and the employer can also contribute to that account. Now, I'm not a financial advisor, and this is by no means any financial advice. However, I have heard that it is prudent to only invest whatever your employer matches if they give you a match. So for example, let's say your employer will match 4% into a 401k, then you should only contribute 4% because that way they're only going to match 4%. Anything above that, you should be moving into other investment vehicles. Again, consult with your financial advisor. That's just the advice I got from a few of them. The next retirement plan that I want to mention is an IRA, individual retirement account. Now, an IRA you can set up on your own. You don't need anyone's help. You don't need an employer. You literally can do it online in minutes. Now, contributions are typically tax deductible, and funds grow tax-free until you withdraw them. The third vehicle I want to talk about is the Roth IRA. Now, a Roth IRA has contribution limits. However, its growth is not only tax-free, so is the interest earned when you withdraw the money. So you won't believe this, but there's actually people out there who still have a pension. What is a pension, you ask? Well, let's look. So a pension plan is a retirement plan that's funded by the employer rather than the employee. There's two main types of pension plans. There's a defined benefit plan and a defined contribution plan. A defined benefit plan is a traditional kind of pension where they take into account your years of service, your salary during those years of service, and they use a formula to kind of get you a number that you will receive for life based on the age you retire. Now, a defined contribution plan is like the 401k, or if you're a teacher, a 403b. This is where you as the employee are putting money into the account, and it may or may not be matched by the employer, but you are personally funding your retirement account that can be used later in life when you stop working and want to withdraw the money to live on. Now, regardless of what kind of plan you have, a pension plan is usually managed by a money manager or by somebody else besides yourself when it comes to how the funds are actually invested and the money that is made within the investments. And when you're ready to take money, a pension plan can either give you a lump sum, or most likely they'll give you a chunk each year to live on, almost like a salary during your retirement years. The big thing to know that when it comes to pensions is knowing how they work, how it's designed, and what you can and cannot do within that pension. There's nothing worse than thinking it's one way for 30 years, contributing to it. All of a sudden you want to take out your money and you didn't realize that it was being mismanaged, the fund hasn't got much growth, yada, yada, yada. Again, just know what you're getting into and how it works before you actually get into it. So here's how to make sense of a retirement plan versus a pension plan. Retirement plans are funded by the employee. Pension plans are funded by the employer. Retirement plans are self-managed, while pension plans have a manager managing the entire fund. Retirement plans are based on contributions and investment performance, where a pension plan is based on years of employment and salary, and they find a formula to give you that pension amount when you're ready to retire. Retirement plans typically have tax-deductible contributions. Pension plans do not typically have tax-deductible contributions. In general, retirement plans offer greater flexibility in contribution amount, in contribution where you want to put the money. A pension plan offers more security versus a retirement plan, but it less flexibility when it comes to saying what you want to do with your money. The easiest way to grasp retirement and pensions are to look at the advantages and disadvantages, of pros and cons list. Let's start with retirement plans. Advantages of a retirement plan. Contributions are tax deductible. They offer greater flexibility in terms of contributions and investment options, and the benefits are based on contributions and investment performance, which could lead to potentially larger growth. Disadvantages of a retirement plan are there's no guarantee on retirement income. The benefits are literally based on investment performance, so if the investment performance is not good, means you could actually lose money in the plan. Contributions are also limited by limits of contribution amount. For example, a Roth IRA has a contribution amount each year of what you can and what you can't put into it. And there's also individuals being responsible for managing their individual retirement accounts, which may seem overwhelming for a lot of people to have to keep track of that. Now let's look at pension plans, the advantages and disadvantages. So with a pension plan, one of the big advantages is contributions are made by the employer. Therefore, they provide a guaranteed retirement benefit. Note on that, I don't think anything's actually guaranteed. I think if we look at the news recently, we've seen a few pensions go bust because of bad investments by the investment manager. But overall, they're said to have greater security than other investment vehicles. Also, benefits are based on a formula that takes into account your salary and your years of service with that employer, also giving you a better sense of financial security. And finally, the employer can handle the investment side of it, meaning they'll hire an investment manager, and that manager is in charge of getting growth into that account. Usually that's how those people get paid too, so they usually are trying to make money themselves. Therefore, a little bit more financial security is what they say, but again, nothing is really ever guaranteed. Now, a disadvantage of a pension is the contributions are not tax deductible, so there's no write-off on that end. There's less flexibility in terms and contributions and investment options, and the benefits may be subject to potential risks such as bankruptcy, underfunding by the employer. Going back to what I just said earlier, not guaranteed, but overall, most pensions do provide some security for a person in retirement. What to look for when selecting the right retirement plan. So age is a big factor when it comes to deciding which plan is right for you. If you're offered a pension, that's fantastic. Not many companies do offer those nowadays. However, if you have the benefit of getting one, then yes, take it. But I also think you should also have a retirement plan in addition to your pension, just to diversify your savings. Another situation to consider is your financial situation. So someone with a higher income level is most likely going to want to prefer choosing their own retirement plan, because then they're going to be able to not only write off those contributions, but also distribute it later in life, so it maximizes their potential to not incur penalties or other taxable income kind of situations. Essentially, the more money you make, you're looking for more write-offs, you're looking to claim less, you're looking to have security, but you got to be a little more deft and clever in how you're taking your distributions so to not trigger taxable events. Third thing is employer contributions. So employer contributions are huge if you have a 401k or a 403b. This is something you can take advantage of if it is offered, and I think it's super wise to take advantage of whatever your employer may match. So if your employer is matching 5%, then you should contribute 5%. But anything over that 5%, I think you're probably better off investing it elsewhere, therefore diversifying your portfolio and not putting all your eggs in one basket, meaning the money manager for your 401k has all your beans, when that shouldn't be the case at all for any one person to have all your financial power. Risk tolerance is huge. Now, if you're in a pension, you kind of don't really have an option on this, but a pension is traditionally more safe and secure, assuming a few unicorns that have gone bankrupt, and we've heard about in the last 10 years or so. Now, in a traditional retirement plan, you got to choose how risky you want to be. The younger you are, the more risk you can take. The older you are, the less risk you can take, simply because you just don't have the time to make up for growth. If the market were to take a hit when you're 62 and you want to retire at 65, it's not necessarily easy to get back those losses in the next 3 years. You might even have to continue working longer unless you have your money diversified in other assets that were not susceptible to big market swings. So longevity is another thing to consider. When are you starting to save? The younger you are, the better. We all know that. But if you are literally in your teens, early 20s, starting out in your career, this is not only a great time to start, but also gives you a better chance to be a little more risky with your money. You can start investing it into other emerging, investment vehicles that aren't necessarily tried and true. These things can give you a higher rate of return. And if you lose, you have more time to make the money back. Another consideration when looking at a retirement plan is inflation. Now, we know inflation is probably going to go up, maybe not every year, but the cost of goods and services over a long period of time are going to increase. Very rarely do they ever go down. So with that in mind, we have to consider making investments, not only that are going to get a high rate of return, but at least high enough to balance out inflation. Therefore, our money isn't actually losing its own value. And the final thing to consider is the tax implication. Depending on the type of investment vehicle you decide to put your money in, your money is either taxed now or taxed later. Tax later sounds like a good deal until you're ready to withdraw it. Then all of a sudden you have a lot more money in there, but you haven't paid the taxes on it. And what happens if the tax brackets change? What happens if they go up? Right now, they're in the 30%. What happens if they go to 60%, 70%? Those are things to consider when investing into other retirement vehicles. It's obviously best to kind of diversify and spread your money out amongst multiple different investment vehicles. But these are things to consider, especially when you're looking at 401ks, 403bs, pensions, IRAs, Roth IRAs, so on and so forth. So I know that's a lot of information to take in, and overall, nowadays we don't have a lot of people who actually even have access to a pension, which is unfortunate. That's just the way the world is moving. That's the way companies are working these days. However, we do all have access to starting retirement accounts. Now, whether you're in your 60s or 70s and watching this video now, or if you're in your 30s and 40s like me, or even in your teens or early 20s, starting retirement accounts is smart no matter what age it is. Yes, your strategy is going to be different based upon the age that you are currently and what your goals are, but don't wait any longer. Start today, start looking at multiple options, figure out where you want to put your money, and start doing it.